Welcome, ladies and gentlemen. It's Zurich Invest event time here at the Dollar Grand Hotel. And with me here is now, I would call it even a mining legend, Peter Marrone, the chairman and CEO of Yamana Gold, one of the top companies in the world in the gold production, universe, I would say. And it's 1 year ago. Welcome first, Peter.
Thank
Always
you.
a pleasure.
Good to see you again. Yes.
Thank you very much for taking the time. And it's almost 1 year ago that we have spoken about, and it was a very interesting year as gold and silver had some ups and downs, I would call it, but also you delivered some great results. And I would dive into 2016. So how was the year for you?
The year was exceptional, and I'm going to credit it all to the interview with you.
Thank you.
We had a wonderful interview, and we had a wonderful year.
Yeah.
We met our production guidance. We were within our guidance on production and on costs. Mm-hmm. And so if we matched the two, that means that we were generating very decent cash flow, exactly in line with our expectations. And in fact, it was a little bit higher than our expectations. So that's great news.
Yes. Fantastic, great. Can you, how many ounces you have produced, let's say, on an equivalent basis?
We produced, we don't show equivalent anymore, but what we do is we divide the three metals. So we produce roughly 115 million, 116 million pounds of copper. It'll be a little higher this year. We produced about 1.25 million ounces of gold, and we also produced a big, decent number of silver, about 7 million ounces of silver. So it's a very decent production, and at costs that gave us great margins. In fact, on the margin side, they improved significantly last year to the year before. We expect to see that again this year. Yeah,
and I mean, also copper had a great ride up. I mean, I remember last year was like 195 was the low, then we went to 280, now it's 262, which is sensational. What were your all-in costs at a pound of copper?
Well, last year we had a slightly higher all-in cost because we had a mechanical failure at that mine. This is our Chapada mine in the second quarter, but boy, did it pick up once they fixed that mechanical failure. One of our crushers was down. And so we needed to retrofit certain things, improve the operational efficiency of it, the maintenance of it. That affected Q2, and that would have affected our overall costs. But we improved significantly in Q3 and Q4. So overall, if I looked at our all-in costs, we were in the high 190s. But if I looked at Q4, which is more representative of what to expect in 2017, it was down significantly to that by about 25 cents per pound. And what's interesting about Q4, by comparison to the last three quarters before that, is that, as you remember, we saw copper price go from an average of about $2.10 per pound to up to $2.70 per pound. And that's consistent with what we've seen in Q1 this year and what we expect to see into the rest of the year.
So that gives you great margin and great profits, of course.
Yes.
Yeah? So if you have divided that metal by metal, what was, let's say, the all-in cost for silver and also for the gold then?
And for the gold side, and clearly gold is the more dominant, but for gold, we were just a little over $900 on an all-in cost. And for silver, we were in the range of about $14 per ounce. So very significant margins to the metal prices. And again, as I say, we expect that to improve very significantly this year and then into 2018 again.
Fantastic. So how is the financial shape of the company up before we come to 2017? Because that's important, you know. I mean, you bought Canadian Malartic together with Agnico. That was a big chunk of money you have invested. But I think it was a great future investment, of course, because the mine is really high profitable. So what is the situation like concerning, like, what do you have cash? What do you have debt, long-term debt? What's the setup?
So we borrowed in 2014 to buy Canadian Malartic, to buy our half of Osisko. We borrowed $500 million in the bond market. As your viewers might remember, we had just gotten an investment grade rating in 14. We renewed it in 15, 16, and we're just about to get it renewed again in 2017. So the credit is a very good credit. Our view was, we prefer not to go into the equity markets to finance this. We prefer to go into the debt markets. We are at all-time low interest rates. Let's take advantage of that. We borrowed 10-year money with an asset that has more than 10 years of mine life. That is exactly the model that we should be following. Our net debt today has declined significantly in the last couple of years. We've improved our net debt by a full $370 million to the end of last year. And we expect that to improve again this year and to improve again into 2018.
Fantastic. Yeah, because that means you are completely taking off the risk of the company.
That's correct, yes.
That's fantastic.
And I'm sure that your viewers are interested in this, an answer to this question, which is what happens with Cerro Moro? And what is interesting about Cerro Moro, it's in development. We're now in the month of April. So that should tell you and others that we are literally 9 months away from mechanical completion and about a year away from operations and the ramp up We expect to start production in early 2018. Cerro Moro is a step change. And what I mean by that is that for the production of 130,000 ounces of gold per year and 9 million ounces of silver per year, that's excellent. But what's really impressive is that the costs are very low. Our cash costs are expected to be $400 to $450 per ounce, and below $7 per ounce on the silver side. So if I looked at the cash flow generation, if I looked at last year to this year and then into 2018, with Cerro Moro, it represents a full 1/3 increase in our cash flow beginning in 2018. That's a very significant improvement to cash flow. And so that also goes to the question of leverage. It improves the leverage because the ratio of net debt to our EBITDA and to our cash flow improves very significantly.
Absolutely. Okay, so then overall, let's say for the whole Yamana company, I would call it, 2017, what is your guidance?
Well, we're expecting, as you may remember, late last year, we said we're going to rationalize the company. We're going to take 4 of the smaller mines, spin them out into a separate company, and we did that late last year. So we now represent in 2017 2 numbers. One is the 6 producing mines of Yamana, and the other is the consolidated number because we still own 70 to 75% of that other company. And so if I looked at it from the consolidated, we expect to produce about 1.14, 1.15 million ounces of gold and about 6 million ounces of silver and 120 million pounds of copper. Copper actually comes up a little bit this year. If I looked at only Yamana, then the 6 producing mines have a production of 920,000 ounces. All the silver comes from those mines and all the copper comes from those mines. So we're representing 2 numbers while we continue to own and consolidate that 70 to 75% of that other company.
Fantastic, great. So of course, question, if I would be a shareholder of you, how would I benefit?
Well, right now we represent what I think is the best value proposition. If I looked at our share price and I compared it to our cash flow, we generated $650 million of cash flow last year. We expect to be able to do that again this year, but with a lesser number of ounces because we have effectively sold off those 4 smaller mines. And with the increase in cash flow that comes in 2018 because of Cerro Moro and the improvements to other operations like Canadian Malartic, our Chapada mine, then what I would say is if we look at a multiple to cash flow, a multiple to net asset value, this year will be a big year. You know that exploration goes in phases. You discover something, you drill it, then it becomes resources and reserves. We've spent 2 years on new discoveries at existing operations. That will translate into resources this year and reserves, increases in resources and reserves on an asset-by-asset basis. So if I looked at it on a reserve basis, resource basis, cash flow basis, net asset value basis, we're undervalued. We're significantly undervalued. And in my view, this is the year where we see that current share price of the company multiply over the course of the next 9 months to a year.
Okay, I see. And maybe something about dividends?
Yes, so we pay a dividend. We've been paying a dividend consistently since 2007. We're a young company. We started with our Chapada mine, our copper gold mine, only in early 2007, and we declared a dividend before we declared commercial production on Chapada with the confidence of the cash flow that we would generate. And the way that I'd like your viewers to look at Yamana is we pay a modest dividend today, but as our cash flow increases, we increase our cash balances, then you should expect that we've already demonstrated that we have a propensity to pay dividends and to increase dividends as our cash balances increase. So I would expect that in 2018, we'll have a decision to make. And I think that will be favorable to shareholders. I am a shareholder of this company. I like dividends. I like getting that check.
Everyone likes a positive balance on the account.
That's correct. That's entirely correct.
Fantastic. Last question. What is, let's say, the average remaining mine life of your projects?
It's high. It's long. If we looked at an asset like Canadian Malartic, we have at least 11, maybe more than 11 years of mine life. Chapada is more than 20 years of mine life. Our Jacobina mine is at least 15 years of mine life. El Peñón is interesting because at the new production level for that mine, we've got roughly 8 years in reserves, more than that with conversion of resources to reserves. So overall then, I would say if I weighted out the overall profile, based on reserves only, we have something in the range of 10 to 12 years of mine life. On resources, more than that. And this year will demonstrate that we can show that we will actually increase that because of increases in resources and proven and probable reserves.
Fantastic, great. That was a great final sentence.
Well,
thank you very much on that. Really, compelling strategy. It's
Thank
a great
you.
company.
Yes.
You guys are doing a great job. I really like it. And with that long mine life, of course, I mean, that's a no-brainer to me.
We look forward to demonstrating that it is a no-brainer and that everyone makes a lot of money on our stock.
I like that.
Very
Thank
good.
you very much, Peter.
Thank you very much. Good.
Ladies and gentlemen, it was Peter Marrone, the CEO of Yamana Gold. And I mean, of course, the company is in phenomenal shape. It's fantastic, paying dividends since 10 years. And also what I like is like from the debt side of the capital, they have like a 10-year structure on the Canadian Malartic, for example, but it's a way longer mine life and they are still paying off the debt consistently at low interest rates, of course. But I like that when a large company really decreases the risk year by year, and on the other hand, they have invested a lot in exploration, and now this is paying out. This is for the benefit for the shareholders, and they want to raise the dividend. We love to hear that. So check out the company. Thanks for watching us. Bye bye from Zurich.